Welcome to the Deep Dive. Today we're tackling investment funds. It's a topic that, well, it pretty much touches everyone thinking about their financial future.
Absolutely. And we've got a great setup for this.
Yeah, we're looking at some, timeless wisdom from Benjamin Graham's chapter on investment funds. He wrote this around 1970, give or take.
And we're pairing that with a more recent commentary, sort of reflecting on how things have changed, or maybe haven't.
Exactly. Our goal is simple, really. Cut through the noise, understand the core ideas about investing in these funds, and see what still rings true for you today.
Right. In Graham's work, it gives this incredible snapshot of the fund world as it existed back then. He really walks us through the basics.
Like what mutual funds were all about, or open-end funds, as he called them.
Yeah, open-end funds always ready to buy back your shares, and then he contrasts them with closed-end funds.
Those have a fixed number of shares, trading on the market more like a regular stock, right?
Spot on. And what's striking is just how big the industry was, even back then. Hundreds of funds, tens of billions in assets. It wasn't small potatoes.
No kidding. And he breaks down the different flavors of funds, too.
Some holding stocks and bonds, balanced funds, others just stocks. And then categorized by their aims,
Like income or stability or growth.
Exactly. Plus, how you actually buy them. Some had that sales charge up front, the load.
Or no load at all.
Right.
Okay, so let's unpack this a bit. Graham points out a really smart feature, how these funds were set up to avoid double taxation for you, the investor. That's a big deal.
It really is. And he mentions these dual-purpose funds. Kind of an interesting concept.
Like slicing a pie two ways, one for income, one for growth.
Pretty much. One slice focused on generating income, the other on potential capital gains. Quite innovative for its time, really.
But he gets down to brass tacks, asking the key questions. The ones probably on your mind right now.
Yeah, like, can you actually do better than just average by picking the right funds? That's a big one.
And maybe just as important, how do you avoid the ones that do worse than average?
Right. And with all these options, how do you even start choosing? Those are still the core questions, aren't they?
Definitely. Now, the more recent commentary offers a really interesting counterpoint, especially to that first question about beating the market.
Ah, yes. The outperformance question. For years, the fund industry's narrative was often, we can beat the market for you.
But this commentary suggests the long-term track record tells a different story.
Pretty much, yeah. It argues that most actively managed funds really struggle to consistently deliver better returns than the overall market average.
And it points to reasons why. Headwinds for the managers.
Exactly. Things like just the sheer scale of money they're handling, the impact of their own fees.
Fees are always a factor.
Always. And the costs of all that trading, buying and selling, it all acts as a drag on performance.
Okay, so here's where it gets really interesting for you, the listener. Back in the 70s, Graham actually seemed to lean towards the idea that funds, overall, were probably a better bet for the average person than trying to pick individual stocks themselves.
Right. His thinking was kind of about safety and discipline. They encouraged saving, maybe save people from making some really speculative mistakes.
But fast forward to today, and the commentary really challenges that view, doesn't it? At least when it comes to those active funds trying to outperform.
It does. It brings in more recent data, decades of it, showing just how tough it is to consistently beat those market benchmarks.
And that idea that winners keep winning. Maybe not so much.
Yeah, it highlights how funds that do great one year often, don't stay at the top for long, low persistence of performance, they call it.
It's fascinating how the context changes the perspective. Graham was writing when the alternative might have been much riskier, less informed investing for individuals.
Exactly. Whereas the commentary has the benefit of hindsight, all that performance data, and, crucially, the rise of new, low-cost ways to invest, like index funds.
So while funds might have offered a kind of safety net back then,
the evidence today suggests actively trying to pick the few funds that will outperform is a very, very difficult game for you to win consistently.
like finding a needle in a haystack, maybe?
Kind of. Some studies show that turnover at the top is incredibly high. Very few funds manage to stay in, say, the top quartile year after year. It's like musical chairs.
So Graham directly asks this question, right? Can you pick those better-than-average funds?
He does. He looked at the top 10 biggest funds from the early to mid-1960s.
And what did he find?
Well, some did continue to do reasonably well over the next 5 years or so, but there was also a lot of shuffling in the rankings, significant variation.
So no magic formula based on past size or success?
Not really, and he specifically cautions against just chasing those spectacular past returns, especially if the whole market's been booming,
Why's that?
because it could be a red flag. It might indicate the fund manager was taking on excessive risk to get those returns. He's basically saying, don't just look at the scoreboard, understand how they're playing the game.
That makes sense. And the commentary really echoes that caution, doesn't it?
Absolutely. It strongly reinforces that skepticism about relying on past performance. It emphasizes just how hard it is, even for pros, to consistently identify future winners.
That high turnover among top funds you mentioned really hammers this home for investors like us.
It does. It suggests your energy might be better spent focusing on things you can control, like, keeping costs low and ensuring you're diversified.
Okay. Now, Graham dives into something he called performance funds. These sound exciting.
They were all the rage in the late 1960s. Laser focused on growth stocks, often stocks with really high price tags relative to their earnings. A lot of speculative buzz around them.
He uses an example, right? The Manhattan Fund.
Yes, the Manhattan Fund,
Yeah.
a prime example. It had this initial really rapid growth,
Followed by...
a significant decline, and some, let's say, questionable investment decisions came to light.
Ouch. So a cautionary tale even back then.
Definitely. He even draws a parallel between that speculative environment and the excesses of the 1920s, despite the SEC oversight being in place by then. It's like he saw history potentially rhyming.
Wow. And it's striking how relevant those observations still feel for listeners today.
It really is. The commentary echoes his warnings about getting caught up in hype, chasing hot returns, and the potential for those high-flying funds to, well, crash and burn.
We've seen similar cycles more recently, haven't we?
For sure. The commentary even brings up the ARK funds as a more recent example. Incredible gains, huge inflows of money.
And then a major correction.
Exactly, which left many investors who bought in late, near the peak, with pretty substantial losses. It really highlights the risks of following the crowd into whatever's hot.
Okay, shifting gears slightly. Graham makes a really interesting comparison. Open-end versus closed-end funds.
Yes. He suggests there might be a real advantage in buying shares of a closed-end fund if it's trading at a discount to its net asset value, the value of all the stuff it holds.
Why is that?
Yeah.
Because you're essentially buying the assets for less than they're worth.
Precisely. Compared to potentially paying a premium, like a sales load for an open-end fund, you're getting a bargain on the underlying assets.
Does he back this up?
He does. He works through a numerical example showing how much that discount on the closed-end shares would need to widen, how much bigger the bargain would need to get before you'd actually be worse off than if you'd paid the load on an open-end fund.
What's the catch?
Well, he acknowledges the selling price of closed-end funds isn't guaranteed, it fluctuates. But he thought a massive widening of that discount, enough to erase the initial advantage, was pretty unlikely.
That's classic Graham, isn't it? Always looking for that margin of safety, that value proposition.
Totally. And while the commentary doesn't dive deep into that specific comparison today,
The focus has shifted a bit.
yeah, it focuses more on index funds and ETFs. But the commentary's emphasis on value and low cost certainly aligns with Graham's core principle here. Indexing is another way for you to get broad exposure, often without those upfront premiums or worrying about discounts.
Right. And speaking of premiums, Graham also talked briefly about load versus no-load funds.
He noted that back then, no-load funds tended to be smaller. Less incentive for brokers to sell them without that commission,
But the modern commentary comes down strongly on the side of lower fees being better for you, the investor, right?
Overwhelmingly so. Which naturally favors no-load funds, but it really puts the spotlight on the super low expense ratios you often see with index funds and many ETFs today.
It's almost like the thinking now is, why pay extra for active management if it doesn't reliably deliver better results and definitely eats into your returns over time?
Exactly that. The commentary highlights tons of research pointing to fees as one of the most reliable predictors of your long-term fund success. Lower fees mean more of your money stays working for you.
It directly supports Graham's instinct to avoid unnecessary costs. And it's just easier now with all the low-cost options.
Much easier. Think of that expense ratio like the fund's annual membership fee. The
Yeah.
lower that fee, the more of your returns you actually get to keep in your pocket.
Graham also touched on balanced funds, the ones holding both stocks and bonds. What was his take?
He suggested that investors might actually be better off handling their bond investments directly rather than through the bond part of a balanced fund.
Why?
Mostly because the income returns he was seeing from balanced funds back in 1970 seemed relatively low. He thought you could maybe do better managing the bond side yourself.
And the commentary. Does it weigh in on balanced funds specifically?
Not in the exact same way, no. But its general recommendation for low-cost, diversified strategies could definitely include you making your own allocation decisions between stocks and bonds.
Using low-cost index funds for each part, maybe.
Yeah, that would fit the philosophy. You maintain control, build your own balanced portfolio, potentially with greater efficiency and lower overall costs.
Which brings us neatly to a really huge development since Graham's era, the rise of index funds.
Yes. The commentary really champions these as a game changer.
Because of the low cost.
That's a huge part of it. But also their ability to just deliver the market's return, plain and simple. They mirror the market as a whole or a specific part of it.
And here's the kicker for you, the listener. After you factor in those lower fees.
They often end up outperforming most of those actively managed funds over the long haul. It's kind of ironic.
It feels like a direct answer to Graham's question about ensuring better than average results, doesn't it? Not by picking winners, but by capturing the average very cheaply.
Precisely. By just aiming to match the market return, like the commentary says, investors in these low-cost index funds often net better results than those paying higher fees for active managers who, more often than not, underperform anyway. It's a powerful shift in thinking.
And then we get ETFs, exchange-traded funds. The commentary covers these too.
Right. Another way, often low cost, to get exposure to different market segments. Plus, they trade all day long like stocks.
Unlike traditional mutual funds that only price once a day.
Exactly. But the commentary also raises some important flags for you to consider.
Such as?
Well, the potential for excessive trading because they are so easy to buy and sell, and the explosion of really specific, sometimes complex ETFs.
You mean things like leveraged funds? Or inverse funds that bet against the market.
Yeah, those kinds of things. It sounds like a useful tool, the ETF structure, but one you need to handle carefully.
That's a critical point. The ease of trading can tempt investors into trying to time the market, which research shows often hurts your long-term returns.
Right, and the caution about specialized ETFs, inverse, leveraged, super narrowly focused ones, is a good reminder. Just because a product exists doesn't mean it's a smart choice for your portfolio.
The commentary mentions a framework for selecting them.
Yeah, Elizabeth Kashner's efficiency, tradability, and fit, basically. Look for low expenses, efficiency, make sure enough people are trading it so you can buy and sell easily, durability, and check that it actually fits your overall investment goals and diversification strategy, fit.
Fit seems crucial. Does this ETF actually match what you're trying to achieve?
Exactly. Does it align with your goals and risk tolerance? Simple questions, but important.
Okay, the commentary also takes a look at ESG funds, the ones focused on environmental, social, and governance factors.
They definitely appeal to investors wanting their money to align with their values.
But the commentary raises some questions for you to think about.
It does. Questions about their actual effectiveness, sometimes higher fees.
Fees again?
Yep. And whether they truly deliver on both fronts, doing good for the world and doing well for your wallet in terms of returns.
It's a nuanced area for sure.
Definitely. The commentary points out that while the intention is good, the higher fees on some ESG funds can be a real drag on your returns.
Yeah.
And there's debate about how much real-world impact they have just by excluding certain companies.
Do they end up holding pretty similar stuff to regular funds anyway?
Often, yes. Significant overlap, but sometimes with that higher price tag. Something for you to weigh carefully.
Okay, finally, the commentary wraps up with a really crucial insight for you, the listener. Maybe the most important one.
Quite possibly. It's that your own behavior as an investor can often have a bigger impact on your actual returns than the specific investments you pick.
The ARK funds example illustrates this perfectly, right?
Absolutely. Those funds had spectacular gains, yes. But when did most investors buy in?
Likely near the peak after seeing all the hype.
Exactly. So many people who chased that hot performance ended up losing significant money when things corrected. The fund's long-term performance might look one way, but the average investor's experience in that fund can be very different.
It really drives home the importance of having a disciplined, long-term strategy and sticking to it no matter what funds you choose.
That really is the key takeaway, isn't it? Investor behavior. It's so often the missing piece. Chasing hot returns, panic selling when things get scary, classic traps that derail your plan.
The ARK example is just a stark reminder of how vital it is to keep that long-term perspective and avoid emotional decisions based on short-term noise.
Couldn't agree more.
So, to kind of bring our deep dive to a close here, we've seen the investment fund world change quite a bit since Graham wrote about it.
Definitely evolved.
But his basic questions, how to get good results, how to make smart choices, they're still incredibly relevant for you today. The answers, though, have shifted with things like low-cost indexing.
Right. That allure of beating the market with active management is still strong, but the evidence suggests it's, well, a tough hill to climb for most people most of the time.
And new tools like ETFs offer flexibility, but also new potential pitfalls if you're not careful.
Which brings us back to those fundamentals. Diversification, keeping your costs low, those remain absolutely essential for your long-term success.
You know, what's really insightful is thinking about how today's low-cost indexing approach actually aligns so well with Graham's core idea of avoiding worse-than-average results.
That's a great point. Instead of the difficult task of picking those few winners, which Graham himself was skeptical about indexing, offers a straightforward way for you to just capture the market's return very efficiently.
And with the crazy number of products out there now, it really forces you to think, how can I apply those principles, efficiency, tradability, fit to make smart choices that actually serve my long-term goals?
It's a continuous learning process for sure.
Absolutely. So we'd really encourage you, our listeners, to explore the world of low-cost index funds and ETFs, dig into their expense ratios, see how diversified they really are.
And maybe take a moment to reflect on your own investment tendencies. Are you sometimes tempted to chase that hot stock or fund?
Consider how just a disciplined long-term approach using broadly diversified, low-cost funds could potentially simplify things and maybe even improve your outcomes in the long run.
Makes a lot of sense.
Well, thanks for taking this deep dive with us today.